Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in corporate filings, and today we are diving deep into Equus Total Return Incorporated's latest quarterly report. This amendment to a previous filing is all about adding some important digital tags, but it also gives us a fresh look at the company's financial health in early 2025, so get ready for some interesting numbers. If you appreciate getting straight insights from corporate documents, make sure you are subscribed and join our Discord community linked in the description below. So here is the deal: Equus Total Return Inc., a Delaware corporation, is filing this document with the SEC. It is essentially an amendment to a previous report to add some required digital tagging, but it means we get to look at their financials again for the quarterly period ended the 31st of March 2025. Now, we are not going to bore you with addresses, but let's get to the meat of it. The company had over 13 million shares of common stock outstanding as of the 31st of March 2025. Let's jump right into the numbers with their condensed balance sheets. As of the 31st of March 2025, Equus had total assets of about $36.5 million. That is up from around $29.9 million at the end of 2024. This increase is largely driven by their investments in portfolio securities, which jumped from $27.5 million to over $32.9 million. They are investing more, which is generally a good sign. Their control investments, which are typically majority-owned companies, went from $27.5 million to $24.5 million, which is a bit of a reduction. However, they made a significant move into non-affiliate investments, adding over $8.4 million here. This means they are spreading their bets a little more. On the other side of the balance sheet, their liabilities increased significantly from about $426,000 to over $2.2 million. This rise is mainly due to a new notes payable of nearly $1.6 million. Interestingly, their capital in excess of par value increased slightly to over $75 million, while their accumulated deficit decreased to over $41 million. This all adds up to a net asset value per S-share of $2.52 as of the 31st of March 2025, a nice jump from $2.17 at the end of 2024. That is a good bump in value for shareholders. Now let's look at how they made or lost money with their condensed statements of operations for the 3 months ended the 31st of March 2025. They brought in total investment income of $338,000. That is up a bit from $283,000 in the same period last year. This income comes from their control and non-affiliate investments. The non-affiliate investments are a new contributor here, bringing in $22,000, whereas last year they had none. However, their expenses also went up. They were $1.4 million for the first quarter of 2025, up from $1.3 million in 2024. A big chunk of that increase comes from transaction costs, which were $307,000 in 2025 compared to $0 the year before. This likely relates to that new debt they took on. This led to a net investment loss of over $1.1 million for the quarter. That's pretty consistent with the $1.09 million loss in the same period last year. But here is where it gets interesting. They had a net realized loss of over $4.2 million in 2025. This is a big change from a net realized gain of $45,000 in 2024. It looks like they sold some investments at a loss. But then they had a huge gain from unrealized appreciation on their portfolio securities. That's a positive change of over $9.3 million, a massive turnaround from a depreciation of $1.3 million in the prior year. This means the value of their existing investments went up significantly. All of this resulted in a net increase in net assets of $3.9 million for the first quarter of 2025. That is a dramatic improvement from a decrease of $2.3 million in the same period last year. So despite the realized losses on sales, the gains in the value of their holdings really boosted their overall performance for the quarter. Looking at the condensed statements of changes in net assets, we see this growth in action. For the period ending the 31st of March 2025, they had an increase in net assets of nearly $4 million from operations. They also had an issuance of warrants which brought in another $744,000. These warrants are like options to buy shares in the future and represent an increase in their capital. This contributed to their total net assets growing to $34.2 million. Now for the cash flow, the condensed statements of cash flow show how money is moving in and out. For operating activities, they had a net increase in net assets of $3.9 million, but when you adjust for cash items like realized and unrealized gains and losses, and changes in operating assets and liabilities, they used $1.59 million in cash from operations. This is a shift from the prior year when they used over $11.4 million in operating activities. So even though operations as a whole are generating value, they are currently spending cash to manage those operations. Financing activities show they brought in $2 million from issuing notes payable and warrants. This is different from the previous year where they had a net cash inflow of over $8 million from margin account activities. Overall, in the first quarter of 2025, their cash and cash equivalents increased by $405,000, bringing their total to $668,000. Now let's look at where their money is actually invested. The schedule of investments as of the 31st of March 2025 gives us the breakdown. Their total investments are valued at over $32.9 million. The majority of this, about 74%, is in control investments. These are companies where they own more than 50% of the voting securities. A significant portion of this is in Morgan E and P LLC, valued at $24.5 million. They also have about 25.9% in non-affiliate investments. These are companies where they own less than 5% of the voting securities. This includes General Enterprise Ventures and North American Energy Opportunities Corp. Interestingly, over 79% of their investments are in the energy sector. This is a very concentrated bet. They categorize their investments based on how their fair value is determined. Most of their investments are level 3, meaning their fair value is based on unobservable inputs. This suggests these are private investments where market prices are not readily available. Their control investments are entirely level 3, and a significant portion of their affiliate investments also fall into this category. This highlights the subjective nature of valuing these assets. The table showing fair value measurements using unobservable inputs for level 3 investments reveals that as of the 31st of March 2025, their control investments were valued at $27.1 million. This is a significant chunk of their portfolio, and it means their value is based on internal estimates and models rather than easily accessible market prices. They use various techniques to value these level 3 investments, like the Guideline Public Company Method and Guideline Transaction Method. These involve looking at similar companies or past deals. For Morgan E and P LLC, they are using metrics like proved reserve multiples and daily production multiples. This is common in the oil and gas industry. Now let's talk about liabilities. On the 7th of February 2025, they issued a 1-year senior convertible promissory note for $2 million. This note carries a 10% interest rate and is convertible into their common stock. This is a pretty significant financing event, and it is a key reason for the increase in their liabilities. Along with that note, they also issued nearly 2 million common stock purchase warrants. These are essentially options that give holders the right to buy shares in the future. This is a way for companies to sweeten a debt deal. Looking at their portfolio activity in the first quarter of 2025, they made a new investment. On the 10th of February 2025, they purchased a 1-year senior convertible promissory note from General Enterprise Ventures Inc., or GEVI, for $1.5 million. They also received warrants for GEVI common stock. They also sold one of their investments, Equus Energy, on the 3rd of March 2025. The proceeds included cash and preferred stock. This sale was a significant event and likely contributed to the changes we saw in their investment portfolio. A big theme here is their intention to convert Equus into an operating company. They are evaluating opportunities for this transformation, but it is a complex process with no guarantee of success. They are seeking shareholder approval and need to enter into a definitive agreement for any transformative transaction. This signals a potential shift away from their current investment company model. Now, for something important, management identified a material weakness in their internal controls over financial reporting. Specifically, they are having trouble with the design and operation of management review over the valuation of their portfolio investments. This means there is a risk that misstatements in their financial statements might not be caught on time. They are working to fix this by enhancing controls and procedures. This is a critical area to watch for any company. So what is the takeaway here? Equus Total Return Inc. is in a period of transition. They've taken on new debt, issued warrants, and continue to invest in companies, particularly in the energy sector. Their portfolio is heavily concentrated, which means a downturn in energy could hit them hard. The fact that much of their portfolio is valued using unobservable inputs, or level 3, adds an element of uncertainty. On the positive side, their net asset value per S-share has increased, and they had a strong increase in net assets due to operations in the first quarter of 2025, driven by changes in the market value of their investments. The move to not qualify as a regulated investment company means they will now be subject to corporate taxes, which is a significant change. The biggest question mark is their plan to transform into an operating company. This strategy is still in its early stages and carries inherent risks. The material weakness in internal controls also needs to be addressed diligently. Overall, Equus is navigating a complex financial landscape. They are trying to grow their investments while also managing debt and preparing for a potential strategic shift. It will be crucial to monitor their progress in remediating their internal control weaknesses and how their transformation strategy unfolds. Alright, that is our breakdown of Equus Total Return Inc.'s latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.